The concept of a fundraising timeline wasn't born overnight. It evolved gradually, hand in hand with the venture capital industry itself. In the early days of venture capital, emerging in the mid-20th century, fundraising was often an ad hoc affair. Entrepreneurs with an idea would seek out wealthy individuals or family offices. These interactions were less structured, more dependent on personal networks and gut feelings. There wasn't a standardized clock ticking for everyone. The process was bespoke, tailored to the specific relationship between the founder and the investor, lacking the formalized stages we recognize today. This meant timelines could vary wildly, from rapid commitments to prolonged, uncertain courtships. As the venture capital industry matured, particularly with the rise of Silicon Valley, the need for more predictable processes became apparent. Firms like American Research and Development Corporation began to professionalize early-stage investing. With more capital flowing and more companies seeking it, a system started to form. Investors began to expect certain milestones and progress reports. This nascent structure was the precursor to today's more defined fundraising timelines. The idea of rounds of funding tied to achieving specific business goals began to take root, bringing a semblance of order to the previously chaotic landscape of innovation financing. It was a natural progression towards managing risk and deploying capital more effectively. The formalization of fundraising timelines accelerated in the later decades of the 20th century. Limited partners who invested in VC funds themselves demanded more accountability and predictable returns. This pressure translated down to the startups VCs funded. The dot-com boom of the late 1990s and its subsequent bust further underscored the importance of disciplined capital deployment and clear timelines. Companies that burned through cash without a plan or a clear path to the next funding round learned harsh lessons. This period solidified the understanding that fundraising wasn't just about getting cash. It was about getting the right amount of cash at the right time to hit critical milestones. Today, fundraising timelines are an integral part of the startup ecosystem. They provide a framework for founders to plan their growth, manage their resources, and communicate progress to investors. While still subject to market dynamics and specific company needs, the general cadence of seed, Series A, B, C, and so on, has become a widely understood language. This evolution reflects a continuous effort to balance the unpredictable nature of innovation with the practical demands of building a sustainable business. The timeline is now a critical tool, not just a suggestion, guiding companies through the challenging journey from idea to market leader, ensuring that speed and strategy are appropriately aligned for scaling. Understanding core financial concepts is non-negotiable for any founder navigating the fundraising landscape. The first crucial term is runway. Runway refers to the amount of time a company can continue to operate before it runs out of cash, assuming its current income and expenses remain constant. Think of it as the length of the literal runway a plane has before it must take off. For a startup, this means how many months of operations are covered by existing funds. Calculating runway accurately is vital for planning the next fundraising round. A short runway creates immense pressure, while a longer one provides more strategic flexibility and time to hit significant milestones. Next is burn rate, which is intrinsically linked to runway. Burn rate is the speed at which a company is spending its capital to finance overheads before generating positive cash flow from operations. It's typically quoted as a monthly figure. For instance, if a company has $1 million in the bank and its net burn rate, expenses minus revenues, is $100,000 per month, its runway is 10 months. Managing burn rate is a delicate balancing act. Spending too little might slow growth, but spending too much can prematurely exhaust resources, shortening the runway and forcing a desperate, often unfavorable fundraising effort. Founders must constantly monitor and adjust their burn rate based on progress and strategic priorities. Milestones are specific, measurable goals that a startup aims to achieve with the capital it raises. These can be related to product development, user acquisition, revenue targets, key hires, or market expansion. For investors, milestones serve as proof points, demonstrating that the company is executing its plan effectively and de-risking the investment. Achieving significant milestones is often a prerequisite for securing the next round of funding at a higher valuation. Failing to hit key milestones can make subsequent fundraising incredibly difficult, as it signals potential problems with the business model or execution capabilities. Clear, ambitious, yet achievable milestones are therefore critical for building investor confidence. Finally, funding rounds are distinct stages in the process of raising external capital. These typically progress from pre-seed and seed rounds, early stage funding for ideation and initial product development, to Series A, B, C, and beyond growth stage funding for scaling operations, market penetration, and expansion. Each round usually involves a larger amount of capital raised at a higher company valuation, reflecting the company's progress and reduced risk profile. Understanding the purpose and expectations of each funding round helps founders tailor their pitch and target the right investors. The progression through these rounds forms the backbone of a startup's long-term fundraising timeline and growth strategy. Several financial theories underpin the structured nature of fundraising timelines. Staged financing is a cornerstone concept. Instead of providing all capital up front, venture capitalists release funds in stages or rounds, contingent upon the startup achieving predefined milestones. This approach mitigates risk for investors. If a company fails to perform, investors can cut their losses by not providing further funding. For founders, staged financing provides necessary capital at crucial junctures, while also imposing discipline and focus on achieving specific, measurable outcomes. It creates a rhythm of performance, assessment, and refunding, which is central to the fundraising timeline itself, ensuring capital is deployed efficiently against demonstrated progress. Signaling theory also plays a significant role in the fundraising process and its timelines. The source and terms of funding can send powerful signals to the market, other investors, and potential employees or partners. Securing investment from a reputable VC firm, for example, can signal high potential and validate the startup's business model, making subsequent fundraising rounds easier. Conversely, a down round, raising funds at a lower valuation than a previous round, or difficulty closing a round, can send negative signals. Founders are acutely aware of these signaling effects and often strategize their fundraising efforts, including the timing and choice of investors, to project strength and momentum, influencing perceptions about their trajectory. The pecking order theory suggests that companies prioritize their sources of financing. They prefer internal financing, retained earnings first, then debt, and finally, as a last resort, external equity. While startups often lack significant retained earnings or access to traditional debt, the theory highlights the inherent costs and information asymmetries associated with external equity. Giving up equity is dilutive to founders and existing shareholders. Therefore, startups aim to raise just enough capital to reach the next set of milestones that will significantly increase valuation, thus minimizing dilution in subsequent larger rounds. This careful calibration directly influences the fundraising timeline, determining when and how much to raise. These established theories now operate within an increasingly complex modern context. Market volatility, driven by macroeconomic shifts, geopolitical events, or sector-specific corrections, can dramatically alter fundraising timelines. During volatile periods, capital can dry up quickly, making investors more cautious and elongating fundraising cycles. Startups might find it harder to secure favorable terms or even to raise capital at all, forcing them to extend their runway through cost-cutting measures. Conversely, investor selectivity becomes more pronounced in such climates. Investors scrutinize deals more rigorously, focusing on companies with strong fundamentals, proven traction, and clear paths to profitability, rather than just growth at all costs. This heightened selectivity means founders must be better prepared, with more robust business cases and conservative projections, significantly impacting their preparation and fundraising duration. A typical fundraising cycle for a venture-backed startup spans approximately 12 to 18 months, from the moment a founder seriously begins planning the next round to when the capital is secured and operational. The first phase is pre-raise preparation, which can take 3 to 6 months. This involves refining the business plan, updating financial models, achieving key interim milestones, and preparing the pitch deck. Founders also spend this time identifying and researching potential investors, seeking warm introductions, and building relationships. It's a period of intense internal work, ensuring the company is in the strongest possible position before actively going out to the market. This groundwork is critical. A rushed pre-raise phase often leads to a weaker fundraising outcome. The second phase is active fundraising, which typically lasts 3 to 6 months, though it can be shorter for hot companies or much longer in challenging markets. This is when founders are actively pitching to investors, attending countless meetings, and navigating due diligence processes. It's a demanding period, often described as a full-time job on top of running the company. Founders need resilience and a thick skin to handle rejections and tough questions. The goal during this phase is to generate sufficient investor interest to create competitive tension, which can lead to better terms and a faster closing. Managing the pipeline of investor conversations and follow-ups meticulously is key to maintaining momentum throughout this intense stage. The third phase is closing the round, which can take 1 to 3 months. Once a lead investor commits and a term sheet is signed, the process isn't over. This phase involves legal due diligence, negotiating definitive legal documents like the stockholders' agreement and investment agreement, and finalizing all administrative details. It requires careful coordination between founders, lawyers, and investors. Delays in this phase are common, often due to complex legal negotiations or unforeseen issues uncovered during final due diligence. Securing the signed agreements and the actual wire transfer of funds into the company's bank account marks the official end of the fundraising effort for that particular round. The final phase, post-raise execution, begins immediately after the funds are secured and, in a sense, merges with the pre-raise preparation for the next round. With fresh capital, the company focuses on executing the plan presented to investors, hitting the milestones that will justify the investment and pave the way for future growth. This period, ideally lasting 12 to 18 months, the runway purchased with the new funds, is about deploying capital wisely to scale the team, develop the product, and expand market reach. Founders must already be thinking about what they need to achieve to be ready for their next fundraising cycle, effectively starting the timeline anew with a clear set of objectives and a ticking clock. All right, folks, let's dive into Section 5, navigating the gauntlet with some real-world fundraising sagas. So, first up, we have Airbnb's fundraising journey, which really provides a compelling case study in navigating those challenging timelines, especially during crises. In their early days, they faced numerous rejections and, well, they famously sold cereal boxes, Obama O's and Captain McCain's, to fund their operations when venture capital was, pretty scarce. This period highlights the grit required when traditional fundraising timelines stretch indefinitely. Later, during the COVID-19 pandemic in 2020, their travel-dependent business was severely impacted. They had to make some tough decisions, including layoffs, and raise debt and equity under duress. This experience demonstrates how external shocks can drastically alter a company's runway and force an emergency fundraising timeline. It demands swift adaptation and strategic pivoting to ensure survival and eventual recovery. Now let's talk about Figma, the collaborative design platform. It illustrates a different aspect of fundraising timelines, the value of patient capital and focusing on product-led growth. Figma spent several years in stealth mode, meticulously developing its product before seeking significant venture funding. Their early funding rounds were spaced out, allowing them to focus on building a superior product and achieving organic user adoption. This approach meant their fundraising timeline was perhaps less aggressive in terms of frequency compared to some hyper-growth startups, but it was strategically aligned with their product development lifecycle. When they did raise larger rounds, it was on the back of strong product market fit and impressive growth metrics. This showcases how a deliberate, milestone-driven timeline can lead to very successful outcomes. On the other hand, Hopin, the virtual events platform, offers a contrasting example of an extremely accelerated fundraising timeline, often referred to as blitzscaling. Launched just before the pandemic, Hopin experienced unprecedented demand for its services. This led to a rapid succession of large funding rounds at quickly escalating valuations, all within a very short period, raising over $1 billion in under 2 years. Their timeline was dictated by hypergrowth and the need to capture a fleeting market opportunity. While incredibly successful in terms of capital raised, this rapid pace also presented challenges in scaling operations and integrating new capital effectively. Hopin's story highlights how market dynamics can compress fundraising timelines dramatically, creating both immense opportunities and significant operational pressures. These examples underscore that while a typical fundraising timeline exists, the reality for many startups can be quite different. Airbnb's resilience, Figma's patience, and Hopin's rapid scaling each demonstrate how internal strategy and external market conditions interact to shape a company's unique fundraising journey. The common thread is the critical importance of aligning the fundraising timeline with the company's specific stage, strategic goals, and the prevailing market environment. Founders must be adaptable, recognizing when to stick to a plan and when to react decisively to unforeseen circumstances, always keeping an eye on their runway and the milestones needed for the next leap forward. Section 6. The interconnected web. Timelines within broader systems. Fundraising timelines do not exist in a vacuum. They are deeply embedded within and influenced by broader interconnected systems. Capital markets, including public stock markets, exert a significant influence. The overall health and sentiment of public markets often trickle down to private markets. A booming IPO market, for instance, can create more exit opportunities for VCs, making them more willing to invest in earlier stages and potentially shortening fundraising timelines for startups. Conversely, a downturn in public markets can make VCs more cautious, leading to longer fundraising cycles, lower valuations, and a greater emphasis on profitability over pure growth for startups seeking capital. Accelerators and incubators play a distinct role in shaping fundraising timelines, especially for very early-stage companies. These programs typically offer a small amount of seed funding and mentorship in exchange for equity, operating on a fixed schedule, often culminating in a demo day. This structure imposes a very specific, compressed timeline for startups to refine their product, business model, and pitch. Demo Day itself acts as a catalyst for fundraising, concentrating investor attention. While beneficial for creating initial momentum and access, this structured timeline can also put pressure on companies that may need more time for development before they are truly ready for external investment. Product development cycles are another critical system intertwined with fundraising. Startups often need to raise capital to fund key stages of product development, from initial MVP, minimum viable product, to scaling features and launching new offerings. The length of these development cycles can dictate when a company needs to seek funding. A company with a long R&D cycle, like a deep tech or biotech firm, will have different fundraising timeline considerations than a software company that can iterate and ship product much faster. Aligning fundraising efforts with major product milestones is crucial to demonstrate progress and justify the need for additional capital, ensuring funds arrive when needed to maintain development momentum. Finally, VC fund life cycles significantly impact startup fundraising timelines. Venture capital funds typically have a lifespan of 10 to 12 years. In the initial years, the investment period, VCs actively deploy capital into new and existing portfolio companies. As a fund ages, VCs shift focus towards supporting their existing investments to achieve exits, IPOs or acquisitions, and return capital to their LPs. This means a startup's ability to raise follow-on funding can be influenced by where their VC investor is in their fund's life cycle. A VC nearing the end of their fund's investment period might be less likely to lead a new large round, potentially impacting the startup's options and the urgency of its fundraising timeline. Section 7. The human cost of the countdown, psychological toll of fundraising. The relentless nature of fundraising timelines can exact a significant psychological toll on founders. The pressure to secure capital, often while simultaneously running and growing the business, is immense. Founders frequently face a barrage of rejections, intense scrutiny of their vision and execution, and the constant worry of running out of runway. This can lead to chronic stress, anxiety, and burnout. The fundraising process often feels like a high-stakes performance where any misstep could be fatal for the company. This sustained pressure can impact decision-making, personal relationships, and overall well-being, making resilience and strong support systems incredibly important for entrepreneurial survival. Employees within a startup are also deeply affected by fundraising timelines, even if they are not directly involved in pitching to investors. The uncertainty surrounding funding can create an atmosphere of anxiety and job insecurity. If a funding round is delayed or seems to be struggling, morale can plummet. Conversely, a successful funding announcement can be a huge motivator, validating their hard work and providing a sense of stability and excitement for future growth. Transparent communication from leadership about the fundraising process and its implications for the team can help mitigate some of this stress, but the underlying pressure of the ticking clock often permeates the entire organization, influencing company culture. Stakeholders beyond the immediate team, such as early angel investors, advisors, and even family members of the founders, also experience the psychological impact of these timelines. They have often invested not just capital, but also time, belief, and emotional energy into the venture. The success or failure of a funding round can therefore have ripple effects, creating tension or relief within this broader network. For early investors, a successful follow-on round validates their initial bet and signals progress, while difficulties can raise concerns about their investment. The entire ecosystem around a startup rides an emotional roller coaster tied to the rhythm of its fundraising cycles. The constant awareness of the fundraising clock can also subtly shape a company's culture and strategic choices. The need to demonstrate rapid progress to impress investors for the next round can sometimes lead to short-term thinking or chasing vanity metrics over sustainable growth. While timelines provide necessary discipline, an overly aggressive or poorly managed fundraising cadence can push a company towards premature scaling or making compromises that are not in its long-term best interest. Finding a balance between the urgency dictated by fundraising and the patience required to build a truly great company is one of the most challenging aspects for founders navigating this demanding landscape. Section 8. Challenging the status quo. Critiques and new fundraising paradigms. Traditional fundraising timelines, characterized by distinct episodic rounds spaced 12 to 18 months apart, face several critiques. One major criticism is their inherent rigidity. This fixed cadence may not align well with the actual progress of all types of businesses, particularly deep tech or research-intensive companies that have longer, less predictable development cycles. Forcing such companies into a standard fundraising timeline can lead to premature scaling pressures or an inability to secure capital when it's truly needed for a breakthrough, rather than when the clock says it's time. This mismatch can stifle innovation or force companies to make suboptimal strategic decisions merely to fit investor expectations. Another critique is the sheer amount of founder time and energy consumed by the traditional fundraising process. Founders often spend 6 months or more intensely focused on raising capital, detracting significantly from their primary role of building the business and leading their teams. This fundraising tax can slow down operational progress and create a cyclical pattern of distraction. The stop-start nature means that just as a company gets back to full operational focus post-funding, the preparation for the next round begins to loom. This inefficiency has prompted a search for models that allow for more continuous access to capital without such prolonged disruptive fundraising efforts. In response to these critiques, several alternative fundraising models and instruments have emerged. Rolling funds, popularized by platforms like AngelList, allow fund managers to accept new capital on a subscription basis, enabling them to invest more continuously. For startups, this can translate into more flexible access to capital. Safes, simple agreements for future equity, and convertible notes have also become standard, streamlining early-stage investment by deferring valuation discussions, thus speeding up the closing process for initial tranches of capital. Crowdfunding platforms, both equity-based and reward-based, offer another avenue, democratizing access to investment and allowing companies to raise from a broader base of supporters, often on their own timeline. Furthermore, revenue-based financing, RBF, is gaining traction as an alternative, particularly for SaaS and e-commerce businesses with predictable recurring revenue. RBF providers offer non-dilutive capital in exchange for a percentage of future revenues until a predetermined amount is repaid. This model aligns funding directly with business performance and avoids the equity dilution and board seats associated with traditional VC funding. These emerging paradigms are not necessarily replacing traditional VC timelines entirely, but are offering founders more options. They allow for greater customization of funding strategies to better suit specific business models, growth stages, and founder preferences, moving away from a one-size-fits-all approach to raising capital. Section 9. The horizon of capital future trajectories in fundraising timelines. Looking ahead, the future of fundraising timelines is likely to be characterized by greater flexibility, efficiency, and data-driven decision-making. One significant trend is the move towards continuous capital access. Instead of discrete, high-stakes funding rounds, some startups and investors are exploring models where capital can be drawn down more fluidly as milestones are met or opportunities arise. This could involve pre-negotiated tranches or ongoing relationships with investors who provide capital incrementally. The goal is to reduce the friction and distraction of traditional fundraising cycles, allowing founders to maintain focus on building their business while ensuring they have the resources they need when they need them. Technology will undoubtedly play a larger role in shaping future fundraising timelines. We're already seeing the rise of platforms that connect founders with investors more efficiently, using AI and data analytics to improve matching and due diligence processes. Automated investor updates and transparent performance dashboards could become more commonplace, providing investors with real-time insights into a company's progress. This increased transparency might lead to more dynamic funding relationships where capital deployment is more closely tied to ongoing performance metrics rather than periodic intensive reviews. This could streamline communication and build trust, potentially shortening the time spent on traditional reporting and relationship management. The criteria for investment and therefore the milestones dictating timelines are also evolving. While growth remains paramount, there's an increasing emphasis on sustainable unit economics, capital efficiency, and a clear path to profitability, especially in more mature startups. This shift may lead to fundraising timelines that are more closely aligned with achieving these fundamental business health metrics, rather than solely focusing on top-line revenue growth or user acquisition numbers at any cost. Investors are likely to demand more robust financial planning and a clearer demonstration of long-term viability earlier in a company's life cycle, influencing how timelines are structured and what needs to be achieved between rounds. Ultimately, the evolution of fundraising timelines will reflect the broader changes in the global economy, technological advancements, and the maturation of the venture capital industry itself. While the core need to fuel innovation and growth with capital will remain, the methods and cadences through which this capital is accessed and deployed will continue to adapt. The future promises a more nuanced, potentially less burdensome and more strategically aligned approach to capital formation, offering founders a wider array of tools and strategies to finance their visions. The rigid clock of the past may give way to more adaptable and intelligent systems for powering the next generation of groundbreaking companies.